The information presented is for informational purposes only. The opinions expressed are not necessarily the opinions of any Daikin company. This information should not be confused for accounting, legal, medical, or other professional advice. Please seek advice from a qualified professional for any specific questions.
Welcome to the Accelerated HVAC Success program. My name is Ben Middleton. I'm the National Sales Training Manager for the Goodman, Amana, and Daikin brands. Today, we're joined here with Matthew Bratsis. He's the Vice President of Contractor Services at EGIA. Matthew, thank you so much for joining us.
Ben, thank you for having me. I love doing these. I love having discussions with you. I'm really honored that you're bringing me on. So I'm excited to have this conversation. I think it's well needed.
You know, I always love having you here. You always have so many great insights to talk about when we get into the world of financing, which is so critical today. I mean, we have seen significant price increases in the equipment. We have seen consumers have been tightening their belts a little bit. Some just because they, going into a savings mode with a little bit of uncertainty. Others just because of the fact that they have to, because we've noticed that credit has gone up. The amount of debt that the average consumer is carrying today is higher,
significantly higher,
historically.
Yeah, and first off, just so you know, I hate using the term finance because nobody likes to use the term of finance. We call it the F word, and I'm trying to ban it from my entire team, even though that is what we do. But no, you are right. It's become more imperative than it's ever been before, and people live on debt. They live on monthly payments, and we've got to start getting the industry understanding that it's not finance. I mean, they start hearing the term finance and they start thinking mortgages and bankers and I need to know numbers. And it is about, and I can't stress this enough, Ben, it's about the actual purchase experience, how consumers actually purchase. And one of the things that drives me nuts is there's nothing more important to a contractor than the actual purchase. Without them actually buying, there's no business. I don't care how well you train them on their installation and your marketing. If they don't actually buy, you don't have a company.
Oh, absolutely.
Right? Yet the one thing they avoid is the F word, the finance, which is the very purchase experience. So we've got to make sure they stop thinking about finance and start thinking about the purchase experience and understand what's going on with Americans, because Americans need that right now.
Yeah, it's so interesting.
And Canadians, by the way, for my Canadian brethren.
But you and I talk about all the time, would there be an automobile dealership around if they didn't offer financing?
Right.
Would the carpet store or the tile store survive without offering financing, or the furniture store or the window company? I mean, we look at all of these other.
Do you think Apple iPhones would be out there if there weren't for payment solutions and there weren't a bill? It's insanity. It's the way we live.
Right. But recently, we talk about interest rates. That's been on everybody's mind.
Yeah.
And so let's talk a little bit about that, because everybody is saying, it's unbelievably high interest rates that we have right now. But you and I have talked about this several different times. So let's go back a little bit further in history. Let's talk about the 1980s a little bit.
Oh, I remember my first mortgage in the late 80s. I can't believe I'm actually saying that. I'm embarrassed to say that. But my first mortgage in the 80s was 13%. And I was thrilled to get the mortgage. And that was the going rate, right? I mean, there's, historically speaking, the rates we're seeing now are very to where they probably should have been, right? It's artificially dropped because of the pandemic and the response to the pandemic and the need to kind of create momentum and keep the economy rolling along. So they drop the interest rates. But there's this recency bias that people sit there and think, well, they should always be zero, right? And that's not the case.
Right.
So I can tell you on a personal note, I'm getting a HELOC right now, and I like to think I have good credit. We could debate that separately. And right now I'm getting a 7.5, and that is perfectly acceptable. That is exactly what you should be getting. And that's on a mortgage. So what do you think an unsecured loan should be at this particular point?
Well, and you and I have talked about that many times before too, right? A bank or whoever the financial institution that is giving that money to the contractor and letting somebody pay back, they take on a tremendous amount of risk.
Right. Well, first off, the cost of money, even if it's at 5 or 6% for them, these are for-profit organizations, and they need to make X amount of dollars.
Absolutely.
And they're looking to make 7 or 8%, quite honestly, because that's what you could get on the market. So you start looking at that. That's why you're looking at 13, 14% interest rates, because they have to break that yield. And then when you consider the risk you're taking with what's going on in the US today, and there's some delinquencies, there's some defaults on loans, you have to factor that stuff in. That is how you get to that 17, 18% interest rate that you're seeing currently. Listen, credit card rates right now are skyrocketing through the roof. You don't get a credit card right now unless you're exceptionally credit for less than 24%. It's just the factor. That's where we're at.
And that's when we take a look at, a lot of contractors out there I think there's a hesitancy because they want to protect their customer.
Yeah. Yeah, they do. And it's amazing how many get it in their mind, like, oh, I don't know if I should be putting the customer into this kind of risk or into this kind of loan and this rate. And what they need to understand is there's not a better alternative out there, right? It is needed. Payment solutions are an absolute necessity. It's not even it's nice to have anymore. It is an absolute necessity. And the way the market is today, there's no such thing as those 5 and 6% rates or whatever it is. Contractors have got to get out of their own way, let consumers make up their own mind.
So if contractor is going out there and they're offering financing on a regular basis, I think the other concern a lot of contractors have, I was just talking to several people here in the Houston market. Well, what if I get that turned down? What if we're not able to get them approved?
Ben, thank you for bringing that up. One of the things that every contractor needs to understand is that the prime lenders, right, and we can sit and name them, Green Sky, Goodleap, Enterbank, Service Finance, Wells Fargo, Synchrony, right? All the big, they are virtually all the same. And they're always going to lend to customers over 700 and give them a fair pricing. Where they were for the past 4 or 5 years, artificially so because of rates and because of the cost of money, is they were willing to drop down into that mid 600, lower 600 range because the cost of money was so inexpensive that the delinquency that was added in with the risk on that, you can easily offset because there was such a spread on your yield. Now that spread and that yield has disappeared, what you're seeing is those prime lenders move from 620, 640, all the way up to 700. And most of them, to be honest with you, they don't want to tell you this, but they're probably underwriting 700 and above, which is given that sub 700 to 620 range, what we would consider the middle class, for lack of a better way of saying, from FICO scores, is really being squeezed out because they're not getting access to those rates. And we're seeing a significant change in the industry below 700. There's no question.
So when you're talking to a consumer that, knows that they have a couple of dings on their credit, they fully expect that they may have to pay a higher rate than what was advertised or proposed.
There is no question. There is no question. We are not seeing any blowback on the consumer side from the rates that have raised, meaning if they're offered a 16.99, a 17.9, and 18.9, especially below 700, again, super prime customers, those 720s and above, they're always going to be able to get an 8, 9, 10% rate. Banks are comfortable because there's no delinquency with those. Those other ones that maybe pay a little bit slower, have some dings, they're perfectly okay getting that 16, 17, and 9. And that's where contractors need to stop thinking about what it was like in 20 and 21 and 22, where the rates were, again, artificially dropped. They need to just let consumers make up their mind because consumers are going to take a monthly payment.
Sure. And I think on the other flip side, a lot of contractors, there is a concern, well, it costs money to offer financing.
It does. And like the banks have two levers. The lenders have two levers. They can either raise your rates to the consumer and go to 17, 18, 21.99, or they can keep the rates where the contractors love to see it, which would be 12.99 or 11.99 or lower, but then they have to make up the money. And where are they going to make that up? Dealer fees. So you're going to see your dealer fee go from 5% to 7% to 10% to higher. So we are seeing, like, it's kind of a pick your poison. Do you want to offer a higher rate to the consumer, or do you want to take on a bigger dealer fee and keep your rates a little bit lower? And that's one of the big challenges. And contractors want neither, but that's just not the reality. They have to accept.
Well, and what's interesting for all of our Goodman, Amana, and Daikin dealers, we have programs in place that actually will help them with those dealer fees. But you and I have talked about this many times too. We have a very low engagement rate as far as the contractors that take advantage of all of those rebates.
And it's actually become surprisingly, it's actually become a little bit lower. Not that I'm trying to like pop a hole in the balloon, but it's actually become lower because now the instant rebate that you guys offer, which is a great program, right? Because the consumer is getting a rebate. But what that's stopped doing is it's not offsetting the cost of finance for these dealers because they're choosing to do that path. So now they're really truly absorbing the 7, 10, 12% dealer fees, which is really like affecting their pricing. What they need to understand is that first off, they should be taking advantage of the Daikin buy down to offset those dealer costs so they can give the consumer a better rate. But what they really need to understand is consumers are less concerned about the big number. They're not concerned about, hey, this is $14,000 or $16,000 or $17,000. There's not that big of a difference to a consumer between $16,000 and $17,000. And if that $1,000 can go to a better financing program and give them a better monthly payment, consumers will take that all day long, all day long.
Well, and the other thing to keep in mind as a contractor, our base program gives them 3% back on the whole entire financed job.
Right.
It's not the cost of the equipment.
Right. And that is significant. When you think about it, again, the tickets used to be $7,000 a couple of years ago. I mean, you and I, we've both been here long enough to know, the average ticket was $6,000, $7,000 on these 14 series. Now even the 14 series are $10,000, $12,000. Right. You start doing the FIT system or the Amana S, you're talking $16,000, $20,000 across the board. And consumers want that energy efficiency. They want that home cooling system, but they're not going to stroke a check for that. And if you can get 3% back on that $20,000 ticket, you do the math. That's $600. That's fairly significant.
Now, you guys are a little bit unique. You mentioned a lot of different banks that are out there.
Yeah.
And banks are the ones that do financing, but you guys kind of work with all of the different banks that are out there, or a lot of the banks that are out there.
We do.
And OPTIMUS has put together, or OPTIMUS is this unique platform. People kind of probably remember you used to go out and shop mortgages, right?
Yes.
So anybody that's bought a home before is you would go out and you'd try to find, and there's plenty of websites that are out there today where you can go and you can look at a whole bunch of different options and then pick which one you want. But you guys kind of made that for the HVAC industry, for the home improvement industry, really.
Yeah, I'm really proud with what we've created. And I don't think we get enough buzz because we're a small little nonprofit. We don't make quite the noise that some of the other lenders go out there and make. What we've created is kind of a one-stop shop. All the lenders, again, every single one of them, I've been doing this for 30 years, every single one of them do the same exact underwriting, right? And right now you're going to get 700 above, you're going to get those approvals. Where we're struggling and where we're seeing a big difference is that sub 700. And if you don't have what we call a near prime and a subprime, some people call it a second and a third look. If you don't have a second and a third look, you are doing yourself as a company and you're doing your consumer base significant, like you're not doing them any favors. You're really kind of hurting yourself because you need to have those lenders in sight. Because again, primes used to go down to 640, 650. They'll still tell you that they're going down to 640. We're seeing the drop off. I can tell you inside OPTIMUS, we're seeing 98% approvals above 700. From 700 to 640 in the prime range, we're seeing it be about 45%. The drop off is significantly. That's where we put in a second lender. And then we also have a subprime. And there is an interesting thing about the subprime, Ben, I'd love to have the conversation about, which is the lease to own product. Now, this one is powered by Mycroft, but we also have Breeze, and there's a couple other lease to own programs. These things 2 or 3 years ago, when rates, again, were artificially low, everybody kind of scoffed at this and was like, I'm not putting my consumer in that. I'm not putting my consumer in it. And while there's not an interest rate associated with them, if you did the math, it's like a 35% interest rate. And people are like, I'm not doing that to my consumer. What we're seeing is they're picking up a significant amount of business right now. They are doubling, almost tripling their volume because of those consumers that are not being approved any longer by the prime lender. They have a no dealer fee, and consumers are very comfortable because remember, their rates haven't changed on the lease to own because it's not a rate program.
Right.
So what used to be high is now super high is now just a little high, but it's a solution. And the pickup on the lease to own is huge. I can't stress this enough. If you're a contractor that's doing, I hate to use the word finance, but if you're doing the finance, you need to have a second and a third, especially a third right now, because that's getting everybody from 630 and under.
Well, it's interesting. So for all those that didn't catch what you said that
Did I go too fast?
subprime, yeah, that subprime has no dealer fee.
Has no dealer fee on my subprime.
Yeah.
No dealer fee, which is beautiful. Now, again, there's not an interest rate associated with it. It's based on the ability of the consumer to pay, and the payments are a little bit higher. But consumers are okay with that because it's about comfort. And even 620s, 630s, 640s right now are being approved for 21, 24%. So being approved for a lease to own without having to worry about that it's not an issue. They're underwriting and giving your approvals.
Right. Well, and it's a big deal. I mean, ultimately, the choice should always be up to the consumer. Your job is to give the consumer the options, and then let the consumer decide what they want to do.
And that's kind of what Optimus does, right?
Yeah.
So when you put in, and I just make sure we're all clear, with Optimus, all you have to do is put in a customer's name and address. You don't need any portions of their social security number. You don't need birth dates. You don't need any other information. You need their name and their address, and you're getting a pre-approval, right? And we're telling you whether it's a prime customer, a near prime customer, and a subprime customer. So we're letting you know before you even go what this customer's at. And if they go into a subprime, it used to be, oh, I don't want to do this. Now the rates are not bad. The rates are market going, and that's an opportunity for you to close a deal that you would have normally walked away from in the past.
Well, you know, you and I've talked about this many, many times, kind of going through different things. When we talk about the different rates that people pay, all of these programs, a contractor at any time can decide to either refinance it, buy it out, or, you know, go ahead and conclude that.
Yeah, there's no prepayment penalty on any of these things. And as a matter of fact, one of the things you need to do if you're going to do the math, and again, with the third look, not to completely focus on this, but it is such a enticing program right now, and it's so being accepted. Our take rate has gone from 20% of the people would take it to now 60 to 70% of the people, when being offered that, are actually saying yes to that program. That's phenomenal. There's no dealer fee, but the faster they pay it off, if they pay it off in 2 years, it actually, you do the math, it comes out to a 19% interest rate. It's actually very, very low. So we need dealers to understand and learn, educate themselves, and step out of the way and let the consumer make their own decision, because it's not a bad program, especially with zero dealer fee.
So Matthew, if you had, you know, one word of advice that you'd want to give all of our listeners in terms of the F word that we've been talking about,
Can't say the F word.
what would be that word of advice that you'd give to our guests?
So the biggest takeaway, and this is how we are training, and this is what we're going to continue to beat the drum to, is stop thinking about finance. Stop thinking about it being mortgages and rates and being bankers, and you have to be, you know, an expert in lending. It is the purchase experience. It's where the rubber meets the road. I think that's the right term, hopefully.
Yeah.
It's where the rubber meets the road. Without them being able to buy, you don't have a company, right? So make sure you're giving every option possible to the consumers so that they can make the purchase. And that includes your second and third. And don't worry about rates. Rates are not your issue, right? You can't do anything about rates. Offer I was going to say finance, but I'm going to say the finance word. Offer those payment solutions, offer the right purchase experience, and your business will skyrocket if you stop thinking about what consumers should or shouldn't have. Let them make their own decision. I can't stress that enough.
Matthew, thank you so much for joining us. I really appreciate
Ben?
whenever you come out here and you know, just enlighten everybody with all of the you know, the trends and things that are happening in terms of you know, contractors, and allowing them to be able to make systems affordable for customers.
Yep.
For all of you that are out there, please go ahead, hit the like button if you'd like to see more episodes like this. Also, please make sure you hit that follow button so that you can be informed of all of our upcoming episodes that we have. Matthew, thank
Ben,
you so
thanks
much.
for having me. I appreciate it. Always glad to be here and help educate everybody. So thank you for having me.